Hello, my name is Dr. Aliya Kenjegalieva, and I'm the unit author and teacher of the Applied Financial Economics unit. Before joining the University of Bath as a lecturer in economics, I worked at the University of Leicester. My research interests are in macroeconomics, monetary economics, finance, banking, and applied macrofinance with a focus on the financial frictions, housing, human capital, and wage inequality. I am an applied macroeconomist, and my research aims are policy-relevant questions. In this video, I will discuss the investment environment topic of applied financial economics, which is taught to MSc students and which is part of my research. Goods and services created in an economy determine the wealth of society, and this production capacity represents a function of real assets. For instance, this can be the land, the buildings, machinery, workers' skills, and knowledge to produce goods and services. Financial assets, on the other hand, are represented by stocks and bonds. These assets are usually pieces of papers or computer entries which do not contribute towards the productive capacity of an economy. However, these securities are the means that give individuals an opportunity to hold claims on real assets. Moreover, holders of financial assets can claim the income that is generated by real assets. For example, you might not own the factory and the associated land and machinery that produces parts for iPhones, but you can own shares of Apple and receive income from these shares, which comes from the production of iPhones. Real assets generate economies' net income, while financial assets define the allocation of income and wealth. Therefore, agents can decide on consuming their income and wealth today or invest it for the future. Investing will mean purchasing various securities. Using the financial funds that came from selling securities, firm can purchase more real assets and enlarge their production capacity. Therefore, investors' return on securities come from these real assets, which were financed by selling financial assets. We will look at financial assets in more details. There are three broad types of financial assets: fixed income, equity, and derivatives. Fixed income or debt securities promise either a fixed stream of income or a stream of income determined by a specified formula. For instance, a corporate bond promises to pay a fixed interest rate that is 2 percentage points higher than the rate of US Treasury bills. Thus, the payment on these bonds are fixed and determined by the formula, unless the issue of bonds declares bankruptcy. Note that floating rate bonds payments depend on the current interest rate. There are two markets that include financial assets with fixed income. The money market that refers to debt securities that are short-term, usually with less than 1 year maturity, highly marketable, and generally of very low risk. US Treasury bills or bank certificates of deposit are examples of money market securities. Capital markets, on the other hand, include long-term securities. This can be, for example, treasury bonds, government bonds, state and local municipalities, and corporate bonds. In terms of default risk, these securities range from very safe, for example, treasury securities, to relatively risky, for example, high yield or junk bonds. Moreover, payments to investors for these securities are designed with various ways of provision and provide protection against the bankruptcy of the issuer. Unlike debt securities, common stock or equities in a firm represent an ownership share in the corporation. Equity holders or shareholders receive any dividend payments the firm may pay and have prorated ownership in the real assets of the firm. Equity holders are not promised any particular payment because these payments directly depend on firm success and profit. Therefore, whenever the firm is successful, the value of equity will increase. and vice versa. As a result, equity investments are riskier than investments in debt securities. Finally, derivative securities, such as options and futures contracts. These securities provide payoffs that are determined by the prices of other assets, such as bond or stock prices. For example, a call option on a share of Intel stock might turn out to be worth less if Intel's share price remains below a threshold or exercise price, say of $20 a share. But it can be quite valuable if the stock price rises above that level. Therefore, derivative securities are so named because their value is derived from the prices of other assets. Other important derivative securities are futures and swap contracts. There are also other financial markets where investors and corporations regularly buy and sell securities. For example, foreign exchange markets where firms which trade internationally transfer different currencies via largest international banks. Another example is commodities exchange markets such as New York Mercantile Exchange or London Commodity Exchange, where firms can buy or sell corn, wheat, natural gas, gold, silver, and so on. Commodity and derivative markets allow firms to adjust their exposure to various business risks. For example, a construction firm may lock in the price of the copper by buying copper future contracts, thus eliminating the risk of a sudden jump in the price of its raw materials. Wherever there is uncertainty, investors may be interested in trading, either to speculate or to minimize their risks, and a market may arise to meet the demand of these speculations. There are three major players in the financial markets, which we will discuss in more details. Firms. Firms demand capital for larger and efficient production. They raise capital to pay for investments in plant and equipment. These real assets generate income which can be used to pay investors the returns for purchasing securities of this firm. Households. Households typically are savers, thus net supplies of capital. They are the investors, as they purchase the securities issued by firms. Governments. Governments can be borrowers or lenders, depending on the relationship between tax revenues and government expenditures. For example, if a government runs a budget deficit, so government expenditures exceeds tax receipts, then it must borrow funds to maintain its excess expenditure. Therefore, it can issue various securities, for example, government bonds, to borrow from the public. If, on the other hand, it has budget surplus, then it is able to repay the outstanding debt. Now let's look at other players in financial markets. Corporations and governments do not sell all or even most of their securities directly to individuals. Instead, they use services provided by financial intermediaries. Financial intermediaries are large financial institutions such as pension funds, mutual funds, insurance companies, and banks. They transfer funds from savers to borrowers. Thus, they stand between issuer, the firm, and the owner of the security, the individual investor. Moreover, corporations do not market their own securities to the public. Instead, they hire agents called investment bankers to represent them to investing public. Financial size of most households does not allow them to invest directly, making it hard for them to find businesses and securities to purchase. Moreover, households lack an ability to diversify across different securities to reduce the risk, but also to assess the credit risk of the borrower. For this reason, financial intermediaries bring the supplies of capital, investors, together with the demanders of capital, borrowers. To do so, financial intermediaries issue their own securities to raise funds to purchase the securities of other corporations. For example, a bank raises funds by borrowing, so taking deposits from households and firms, and lending that money to other borrowers. The spread between the interest rate paid to depositors and the rates charged to borrowers is a source of banks' profit. Thus, lenders and borrowers do not need to contact each other directly. Therefore, a bank acts as an intermediary between the two, which solves the problem of matching lenders with borrowers. Other examples of financial intermediaries are investment companies, insurance companies, and credit unions. They offer similar advantages in their intermediary role. First, by accumulating the resources of many small investors, they can lend considerable sum to large borrowers. Second, by lending to many borrowers, intermediaries achieve significant diversification, so they can accept loans that individually might be too risky. Third, intermediaries build expertise through the realm of business they do and can use economies of scale and scope to assess and monitor risk. Most households' portfolios are not large enough to diversify if using services of investment companies. Brokerage fees and research costs will be expensive if investor can afford to buy only one or two shares of various firms. Mutual funds have the advantage of large-scale trading and portfolio management, while participating investors are assigned a prorated share of the total funds according to the size of their investment. The system gives small investors advantages they are willing to pay for via a management fee for the mutual fund operator. Investment companies can also design portfolios specifically for large investors with particular goals. In contrast, mutual funds are sold in the retail market, and their investment strategies are likely to attract many smaller clients. Like mutual funds, hedge funds also pool and invest the money of many clients who are mainly institutional investors, such as pension funds, endowment funds, or wealthy individuals. They are more likely to pursue complex and higher risk strategies. They typically keep a portion of trading profits as part of their fees, whereas mutual funds charge a fixed percentage of assets under management. Investors in most cases do not hold specific knowledge or time to collect and analyze the data about different companies' financial situation and their securities, but they're willing to pay for this information, which arises as a demand that is satisfied by many financial intermediaries who can perform the services and charge for it. Firms raise much of their capital by selling securities such as stocks and bonds to the public. Because these firms do not do so frequently, investment bankers that specialize in such activities can offer their services at cost below that of maintaining an in-house security issuance division. Therefore, these investment bankers are called underwriters. Investment bankers advise the issuance corporation on the price it can charge for the securities issued, appropriate interest rates, and so forth. Ultimately, the investment banking firm handles the marketing of the security in the primary market, where new issues of securities are offered to the public. Later, investors can trade previously issued securities among themselves in the so-called secondary market. For example, for most of the last century, investment banks and commercial banks in the US were separated by law, which was called Glass-Steagall Act, which was eliminated in 1999. However, in September 2008, All the remaining major US investment banks were absorbed into commercial banks, declared bankruptcy, or reorganized as commercial banks.